Part 4, Why Stocks Go Up and Down. This section of the book aims to provide a universal framework for understanding and evaluating stock price behavior. When is a stock cheap or expensive? Stock prices are related to a company's long-term growth potential and its ability to generate free cash flow. Free cash flow can then be returned to investors in the form of dividends or reinvested in the company to increase future earnings. In general, small, rapidly growing companies will choose to reinvest their free cash, and more mature companies will return at least a portion to investors in the form of a dividend. The price-to-earnings ratio. There are several ratios that investors look at to determine whether a stock is cheap or expensive, the most common being the price-to-earnings ratio. It is defined as the stock price divided by the earnings per share, as shown below. The P/E can be calculated using past, trailing, or estimated future, forward earnings. Investment banks such as Morgan Stanley, Goldman Sachs, and others employ analysts to follow stocks and issue future earnings estimates on the companies they follow. These are then aggregated by data providers who publish a consensus estimate of earnings per share, EPS, for many different companies. Forecasted earnings should be used when looking at P/E ratios because the stock market anticipates. This means companies with greater growth potential and whose earnings can be predicted easily will generally trade at a higher P/E ratio. So what is a high or low P/E ratio? The book states there is no such thing as a correct P/E ratio, but there are 3 ways to help determine an appropriate level. 1. Historical analysis. 2. Comparison to peers, and 3. Comparison to market. Historical analysis. When evaluating a company's stock, a good place to start is to compare the current P/E ratio to the historical range. This gives an idea of what a reasonable P/E multiple is for the stock going forward, assuming a similar level of growth is expected. In addition, the range allows us to quantify the potential upside and downside of an investment. Let us look at the example below for Diversified Manufacturing Inc. DMI, at a price of $27 in December 2014. The price of a stock reflects investors' expectations of future performance. It can be seen that the P/E ratio fluctuates widely throughout each year, reaching an average low of 15 and a high of at least 25. At the current price of $27 and 2015 estimated EPS of $1.60, DMI is selling at a P/E of 16.9x 2015 earnings and appears low. Unless the market is depressed in 2015 or there is some new development in the company outlook, it is possible that the stock will reach a P/E of 25 sometime throughout year, which translates to a stock price of $40 and a 48% gain. On the other hand, it is also possible that the stock will drop to a P/E of 15 and a price of $24 at some point in the year, which corresponds to an 11% loss. At the current price, there exists a reward/risk ratio of 48%/11%, or about 4:1. And that the stock appears undervalued. Although this is an extreme example, as P/E ratios do not typically fluctuate this widely, it illustrates the concept well. Investors may increase their upside potential and mitigate their downside risk by buying a stock when it is selling at the low end of its P/E range. However, the historical range can only be considered reasonable for the future if the growth rate of earnings is expected to be about the same. Nothing has changed in the company or industry to affect an investor's confidence in his earnings estimates, and the whole market's evaluation of P/Es has not changed. Here, if we simply use the P/E ratio, it appears EVCT is overvalued to its peers. But this would be a naive conclusion since it has a higher expected growth rate. This is why some growth investors argue that the most expensive rate. This is why some growth investors argue that the most expensive, highest P/E stocks are often the best investments. It becomes apparent that the P/E ratio is not sufficient to compare peers because they are all growing at different rates. Therefore, we introduce the concept of the price/earnings to growth, or PEG, ratio, which is calculated by dividing the P/E multiple by the expected growth rate. Expected long-term growth rates are published by investment banks and a consensus value can be found online. When we calculate the PEG ratio for these companies, EVCT at 1.13 is lower than the average of 1.26. This indicates that while EVCT trades at a higher P/E multiple, it may still be undervalued due to its faster expected growth rate. This analysis assumes that the companies being compared have equivalent levels of risk, which is not always the case. Comparison to market. The third way to use the P/E ratio is to compare it to the P/E of the market as a whole. This is called a relative multiple and is calculated by dividing the P/E multiple of a company by the P/E of a readily available index, most commonly the S&P 500. A relative multiple of greater than 1 signals that the stock is trading at a premium to the market, while a multiple of less than 1 signals a relative discount. In order to put this number in perspective, we could look at the historical range as we did with the P/E ratio and compare the growth rate of the company to the market as a whole. Overall, the P/E ratio is not a perfect valuation metric, but it is the most common tool that investors use to evaluate companies. It is important to note that we have only considered the P/E to be related to the earnings growth rate, whereas in actuality there are many other factors, both quantitative and subjective, that contribute. This is a good fundamental start. Other valuation metrics. While not as widely used as the P/E ratio, a stock may also be valued using the price-to-cash flow ratio. Cash flow in this context is typically defined as cash flow from operations. Free cash flow may also be used, but is much more volatile and can change a lot from year to year. In either case, the price-to-cash flow ratio is calculated by dividing the stock price by the cash flow per share. The price-to-cash flow ratio can be used to value a company in the same ways that the P/E is used, by drawing analogies to history, peers, and the market as a whole. There are several scenarios when this is the advantageous statistic. It is commonly used when a company is losing money, just breaking even, or only making a small profit. In these cases, the P/E ratio would be meaningless because the company has little or no earnings. Additionally, it should be used whenever a company has a large depreciation or deferred tax figure that causes the net earnings to look low compared to the cash flow, or when comparing two or more companies that use different depreciation accounting methods. The price-to-sales P/S ratio may also be used as an alternative to the P/E ratio. It is calculated by dividing the market capitalization, stock price x number of shares, by the projected sales. This is often applied to rapidly growing companies early in their life cycle, when high development and manufacturing costs lead to minimal or negative earnings and cash flow. Just as with a low P/E or low price/cash flow ratio, a low P/S ratio compared to peers may signal that a stock is undervalued, assuming similar growth rates. The P/S ratio may also be divided by the expected growth rate for A. The P/S ratio may also be divided by the expected growth rate for A. Normalized comparison. Another valuation tool that is frequently used by investors is the enterprise value to EBITDA ratio. Enterprise value, EV, represents what a company may be worth to a potential buyer and is defined as follows. Debt is added to the market cap because if an investor bought a company, he would become responsible for the debt of that company. Similarly, cash is subtracted because the investor could pay himself the cash as a dividend and effectively reduce the cost of the company. EBITDA is earnings before interest, taxes, depreciation, and amortization. The EV/EBITDA ratio is essentially a measure of the value of the company, divided by what it can earn for all its security holders, stock and bond holders. This is in contrast to the P/E ratio, which only considers what a company can earn for its stockholders. The EV/EBITDA is most often used to compare peers, with a low ratio signaling a possible undervaluation. A thorough investment analysis requires the use of all these valuation tools, as well as consideration of the ratios presented in Part 1. Whichever metrics are used, the risk/reward ratio can be tilted in an investor's favor by buying when he considers a stock to be undervalued when compared to its own history, its peers, and the market as a whole. After a stock is bought, it is essential to revise one's analysis as new information surfaces. Eventually, it may reach a point of overvaluation and should be sold. It is important to note that these measures assume the market is generally efficient, which means wide discrepancies between a company's intrinsic true value and stock price either do not exist or cannot be accurately quantified. Why stocks go up and down? With our understanding of business fundamentals, valuation ratios, and remembering that stock prices anticipate future events, the book attempts to Remembering that stock prices anticipate future events, the book attempts to present a working explanation of why stocks go up and down. Stocks go up and down in response to changes in perception of a company's ability to generate earnings and pay dividends, both in this year and the future. Changes in perception can arise from developments within the company, in the company's competitive environment, or in the economy in general. Notice that this explanation does not attempt to explain why a stock sells at a certain price, which is a fundamentally more difficult question than whether it will move up or down from its current level. The authors note that there is no substitute for experience and that new investors should choose a group of stocks to watch daily and stay tuned into all the news about those companies. Watching whether or not prices respond to news developments over a period of time will help you develop an awareness of 1. What expectations are reflected in a stock's price? 2. Which information will likely impact future earnings? 3. What the current sentiment of the market is toward the company and industry it operates in. After a period of time you will find yourself becoming sensitized to which factors are important and which are less meaningful. If you enjoy this content and similar content, please consider liking, subscribing and hitting the notification icon. Please also consider seeing some of the affiliate links in the description below, and it really helps out the channel. Thank you. Have a wonderful day.